What's up everybody, welcome back to my channel. In this video, I'm going to be covering the fastest valuation method that allows you to value a company relatively accurately in under 5 minutes. It requires minimal math. All you really need to be able to do is add, subtract, and divide, and you'll be able to find the valuation of a company in less than 5 minutes. This is a valuation method that was pioneered by Warren Buffett back in the 1980s, and it is one that is still very useful today. By the end of this video, you're going to know when it is useful to be applying this valuation method. You're going to know exactly how to use the valuation method, and we're going to do that by going over a few real-world examples just to show you when this valuation method is useful and when it is not. So with that, let's get right into it. Now, when it comes to valuing a company, there are 3 broad valuation approaches that you can take to valuing a business. The first is the liquidation value, the second is the going concern value, and the third is the market value. The liquidation value is used when you're trying to value a company that is operating in an industry that is no longer viable, or a company who is about to go out of business. Unless you have an investment strategy or a trading strategy that requires you to invest in companies that are about to go out of business, this isn't necessarily an approach that is worth you looking into, because most investors are not going to be investing in companies that are about to go out of business. The second valuation method is the going concern value. Now, to find the going concern value of a company, essentially what you want to do is find the present value of future free cash flows that the company is going to generate. Some valuation methods that find the going concern value of a company are the discounted cash flow model, the earnings power value model, and the valuation technique we're going to be talking about today, which is owner earnings. This is probably the most used valuation technique that is used by most investors and analysts in the market today. So it is very useful to understand how to conduct a going concern valuation for a company. The third and final valuation method is the market value approach. This is generally used for high growth companies or companies that are not yet profitable, and the way that you find the market value of a company is by comparing it to its peers. So this is when you would compare the price to earnings, price to book, or price to sales ratios of different companies, and this is also what is called a relative valuation. However, as a value investor, I always use the going concern valuation method for finding the intrinsic value of the companies I'm looking to invest in. So I'm going to be showing you the fastest going concern valuation approach that I have found today that is going to allow you to find the intrinsic value of a company in less than 5 minutes. So as I alluded to, that valuation technique is owner earnings, and it is very straightforward. It is made up of just 2 components, a numerator and a denominator. It's really that simple. The numerator is going to be the free cash flows that the company has generated in the most recent year, and the denominator is going to be some discount factor that we're going to use to discount those free cash flows. Essentially, what this valuation method is finding the perpetuity value of a company's free cash flows. Now, while it is an extremely simple valuation method, that does come with its drawbacks. One of those is that it does not take into account future growth for the company. Since you are essentially finding the perpetuity value of the company's free cash flows as if they're going to remain constant at today's value, you're not taking into account any future growth in free cash flows. If you are using this valuation technique for a growth company, you're probably going to find that a lot of the growth companies are going to seem to be overvalued. But that's just because this valuation technique does not take into account future growth. And this valuation technique is the one that I generally use when I'm screening stocks and I'm trying to decide which stocks are going to be worth me looking into. So let's get into how to use the formula because it's extremely simple and it just takes a few minutes to explain. The first part is a numerator that consists of the free cash flows the company has generated. Now, to calculate the free cash flows, all you have to do is take the operating cash flow produced by the company in the most recent year and subtract the capital expenditures the company has made in that year. The reason why you want to subtract capital expenditures is because capital expenditures are a necessary cash outlay that every single company needs to make in order to remain competitive in their industry. Capital expenditures represent the spending that a company makes on buying property, plant, and equipment. And the reason they need to do that is because they need to replace property, plant, and equipment that has aged and is no longer able to produce economic benefits. And they also need to grow their property, plant, and equipment so that they can grow the revenues of the company over time. So capital expenditures are a necessary cash outlay for every company, and that is why you want to subtract capital expenditures from operating cash flows. Now that you have a numerator, all you have to do is divide by a discount factor in order to find the intrinsic value of a company. Now, I generally use 3 different discount factors. And the reason why is because I want to provide myself with a range of valuations that lets me know if the company is relatively overvalued or if it is grossly undervalued. Now, the first discount factor I'll use is the risk-free rate. This is going to provide me with the highest valuation for the company because the risk-free rate is going to be the lowest denominator that you can possibly use to discount future free cash flows. Now, this is actually what Warren Buffett used to do in the 1980s and 1990s. However, back then, the risk-free rate was a lot higher than it is today, which today it's around 0.8%. So for that reason, using the risk-free rate today, given the current market conditions, is probably going to be providing you with an extremely large valuation, and it won't be that valuable. But under market conditions where the risk-free rate is a little bit higher, it can still provide you with a relatively reasonable valuation. The second discount factor that I will use is the weighted average cost of capital for the company. This takes into account the cost of debt for the company and the cost of equity for the company. So I think that using the weighted average cost of capital as a discount factor provides you with the most reasonable valuation for most companies most of the time. And the third and final discount factor I'll use is something a little bit higher. I'll use something like 10%. Just to see what the valuation of the company would be if inflation just exploded in the economy or interest rates just skyrocketed out of nowhere. I want to know what impact that would have on the valuation of the company. Once I have that range of valuations for the company, if the company is trading above the valuation that is provided by discounting the free cash flows by just the risk-free rate, that tells me that the company is probably overvalued and that I don't want to be looking into it. If the company is trading more towards the valuation that I get when I'm discounting the future free cash flows by the higher discount factor of 10%, then that tells me that the company is likely undervalued, and that's a company I want to conduct a more in-depth valuation on and actually look into the business model a little bit more. Now, this is very particular to my investment strategy because I'm a value investor, but I do think that this is a very valuable valuation technique that almost anybody can apply in order to find the intrinsic value of a company relatively quickly. So now let's use a real world example just to see how it plays out. And the two companies we're going to be using are Apple and Uber. Now, Apple generated approximately $80 billion of operating cash flows in the last 12 months. And they spent about $8.3 billion on capital expenditures. So that gives us free cash flows of $71.7 billion. So that's going to be our numerator. In the denominator, we're going to use the risk-free rate of 0.81%. The weighted average cost of capital for the company, which is 3.2%, and then we're going to also discount it by the 10% on the off chance that inflation comes roaring back or interest rates just skyrocket and Apple's future free cash flows have to be discounted at a higher discount factor. Now, when we divide by the current risk-free rate of 0.81%, we get an intrinsic value over $8 trillion for Apple. Now, clearly, with the risk-free rate being so low, this is a very misleading valuation. So it's really not providing us with that much insight on what the true intrinsic value of the company may be. But we can get a better idea when we divide it by the weighted average cost of capital. When we divide $71.7 billion by 3.2%, we get an intrinsic value of $2.2 trillion. Now, given that Apple is currently trading at about $1.9 trillion, that shows us that Apple is trading relatively near what is a pretty fair valuation for the company, given its current weighted average cost of capital. However, if we divide $71.7 billion by 10%, we get an intrinsic value of just $717 billion. Now, that tells us that if the market conditions were to change very drastically and very sharply, then Apple is currently overvalued by approximately 150%. So that just tells us that while Apple is trading at a relatively fair valuation given today's market conditions, if market conditions were to turn sour, then Apple would be pretty overvalued. So the insight that this provides you with is that Apple is trading near a fair valuation. However, it is certainly not undervalued given today's market conditions. Now, the second company we're going to take a look at is Uber. And the reason why I want to go over Uber is just to show you that this valuation technique isn't necessarily applicable to all companies. Now, Uber generated around negative $4 billion in operating cash flows, and on top of that, they spent over $1 billion on capital expenditures. So if we input these values, which gives us a numerator of about negative $5 billion, and the denominator really doesn't matter, this gives us an intrinsic value for Uber that is negative. Clearly, Uber is actually worth something, so this valuation technique doesn't necessarily give us an accurate valuation of Uber. For Uber, you'd probably want to be using a market value approach, rather than using a going concern approach, because it's pretty tough to predict what the future free cash flows that Uber is going to be able to generate in the future are going to be. So that does it for this video. I hope you guys enjoyed. As always, I'm not a financial advisor, but I do hope you enjoyed and learned something from this video that you're going to be able to apply to your own investment strategy in the future. I hope you guys have a great weekend, and I look forward to seeing you in my next video.